This isn't inflation anymore, it's abandonment. Something has crossed a line, and markets are reacting before the story is officially told. Prices for real assets aren't creeping higher, they're exploding upward. And that kind of move doesn't happen because people feel confident. It happens because they no longer trust what they're holding. Here's the paradox. Paper money still circulates, governments still operate, banks still open their doors, yet faith in the system behind them is evaporating anyway. Gold and silver aren't moving because investors want upside. They're moving because investors want out of promises, out of claims, out of assets that depend on someone else staying solvent tomorrow. And this isn't distant or theoretical. It touches you directly. The currency you earn, the cash you save, the numbers on your screen still look normal. But what those numbers can actually buy is changing fast. This isn't a market cycle. It's a psychological break. A moment where people stop asking how high returns will be and start asking what will still hold value at all. Once that question takes over, markets don't behave politely anymore. They reprice reality, and most people haven't caught up yet. That's where this story actually begins. The trigger for this shift isn't panic, it's structure. The global financial system rests on one assumption above all others, that sovereign bonds are safe, that they anchor everything else. But that anchor is starting to drag instead of stabilize, and the stress isn't coming from a weak economy. It's coming from the plumbing of the system itself. Look at what's happening beneath the surface. One of the world's largest creditors is no longer exporting capital the way it used to. Money that once flowed outward to support global borrowing costs is being pulled back home. That reversal quietly removes a critical pillar of demand for government debt elsewhere. Here's the question that reframes the entire situation. What happens when the safest asset in the system stops being trusted? When that belief cracks, rate cuts lose their power, policy statements lose their authority, markets stop reacting to guidance and start reacting to balance sheets. The conversation shifts from growth to solvency, from returns to survival. That's why stress can rise even when officials sound calm. The issue isn't short-term policy, it's long-term confidence. And long-term confidence doesn't respond to reassurance once the mechanics change. This is how a structural issue announces itself, quietly at first, indirectly, through behavior rather than headlines. And once behavior shifts, it spreads faster than any official response can contain. There's a claim sitting underneath this moment that's uncomfortable to say out loud. Control has already shifted. For years, central banks shaped outcomes by moving rates and managing expectations. That only worked because markets trusted the bond market to remain orderly. But once bonds start trading on solvency risk instead of stability, that control evaporates. You can see it in the behavior. Long-term yields move on their own. They ignore calming language. They ignore short-term adjustments. Instead of asking how fast growth will return, markets are asking who will absorb the debt that's coming next. Notice what's missing from the response. There's no credible plan to stabilize long-term funding without expanding the money supply. There's no buyer of last resort that doesn't involve printing, and there's no commitment to discipline that doesn't immediately threaten the system itself. That absence matters, because when markets realize the only backstop is currency creation, bonds stop acting like safe havens. They start acting like accelerants, selling feeds, selling yields rise, deficits widen, and intervention becomes inevitable. This is where the story flips. The market is no longer waiting for policy, policy is chasing the market. And once that relationship reverses, prices don't adjust gradually. They jump, because confidence doesn't fade in a straight line. It breaks. Once confidence breaks at that level, the problem stops being purely financial. It turns geopolitical. When shared trust disappears, cooperation follows it out the door. Trade stops being about efficiency and starts being about leverage. Countries don't ask what's cheapest anymore, they ask what's secure. You can see this shift clearly. Globalization gives way to tariffs. Open markets give way to reciprocal punishment. Currency strength is no longer treated as virtue, it's treated as vulnerability. A weaker currency becomes a tool, boosting domestic competitiveness while quietly taxing anyone who holds it. Here's where the story flips again. When money becomes a weapon, neutrality disappears. Foreign holders react fast. Exposure gets cut. Assets that depend on trust lose their premium. Assets that exist outside permission-based systems gain one. And the cycle feeds on itself, because every defensive move confirms the fear behind the next one. What looks like policy disagreement is actually fragmentation. The global system is no longer moving together, it's pulling apart. And when systems fragment, prices don't drift, they gap. This is how economic pressure becomes economic conflict without a formal declaration. Quiet at first, then sudden. And once markets sense that divide, they don't wait for clarity. They position for separation before it becomes unavoidable. The next escalation isn't abstract, it's physical. As trust breaks down, access to real resources starts replacing price as the priority. Governments stop assuming markets will deliver what they need. They move to secure it directly. Mining, energy, and materials are no longer treated as businesses. They're treated as strategic assets. You can see the shift in behavior. Projects that once stalled on economics suddenly get approved on security grounds. Territories once discussed diplomatically are reframed as necessities. Extraction becomes urgent not because it's profitable, but because supply can't be left to chance. Here's the detail that changes how you should see this. When resources are labeled critical, they stop being part of the free market. Silver and copper cross that line first. Access tightens. Supply chains get locked down. And once governments compete for physical materials, price signals arrive too late to fix anything. That's the contradiction. Markets still quote prices, but decisions are no longer driven by price. They're driven by survival logic, and survival logic doesn't invite selling. It invites hoarding. Once that mindset takes over, shortages stop being temporary. They become structural, and structural shortages don't resolve with higher prices. They escalate into control. That control shows up next in a place most people assume will adjust automatically. Supply. In theory, higher prices bring more production. In reality, this market doesn't work that way. Most silver isn't mined because someone wants silver. It comes out as a byproduct of other metals. That means supply can't surge just because prices do. It barely moves at all. At the same time, demand doesn't flinch. Energy systems need it. Electronics need it. Defense systems need it. These sectors don't negotiate with price. They secure inventory because failure isn't an option. That turns the market one-directional. Now watch how fast this stacks. Physical demand accelerates, inventories thin, and then something unusual happens. Paper contracts start getting challenged. Buyers who were expected to settle in cash ask for delivery instead. That's the stress point the system was never designed for, because paper markets only function if most claims are never redeemed. Once redemption becomes the priority, leverage collapses. Exchanges tighten rules. Settlement delays stretch. Confidence drains from the mechanism that sets the price. Here's the question that forces a reckoning. What happens when claims massively outnumber what actually exists? Because at that point, price stops discovering value. It starts rationing access. And rationing never ends calmly. When rationing begins, the damage doesn't stay inside exchanges or trading desks. It spreads outward into the real economy. Delivery times stretch, premiums detach from quoted prices. Two people see the same spot number and experience completely different realities. One can't find supply at all. The other can't sell without taking a steep loss. Liquidity, which is supposed to make markets efficient, starts doing the opposite. This is where stress becomes personal. Dealers hesitate, buyers rush, sellers freeze. Infrastructure built for steady flow starts choking on volume and speed it was never designed to handle. And once confidence in that infrastructure weakens, behavior changes instantly. The questions people ask shift fast. Not is this a good price, but will this still be available? Not should I wait, but can I still get out? Those aren't investment questions anymore, they're access questions. If this feels familiar, say so in the comments, because when enough people focus on access instead of price, markets stop functioning normally. They turn into queues, and queues don't reward patience or analysis. They reward whoever moves first. And once that psychology sets in, the system can't rewind. It can only push forward under pressure. To understand why this keeps accelerating, you have to step back and look at the system as a whole. What's failing isn't a single market. It's the assumption that all markets remain connected through trust and arbitrage. That assumption only holds when goods can move freely, rules are predictable, and prices are honored. Once those conditions weaken, markets don't correct. They fracture. You can see that fracture forming now. The same asset carries different values depending on location, delivery, and control. Paper prices reflect leverage and promises. Physical prices reflect scarcity and urgency. And when those two diverge, the paper side loses authority fast. Here's the unsettling insight. A global price only exists when trust is universal. Scarcity destroys that universality. Once governments and institutions prioritize guaranteed access over the cheapest price, arbitrage fails. Metal stops flowing to where it's overpriced. It stays where it's needed most. Borders, controls, and national interest override the math. This is what the end of a unified market actually looks like. Quiet at first, then unmistakable. Two systems operating in parallel with different rules and different outcomes. And once fragmentation is accepted, the next question isn't how high prices go. It's who gets to set them. Here's the final insight that pulls everything together. What you're watching isn't a speculative frenzy or a temporary breakdown. It's a transfer of priority from promises to possession, from speed to control, from systems that expand endlessly to systems that collide with limits. When trust-based assets fail, value doesn't disappear. It moves, and it moves toward whatever exists outside permission, outside leverage, and outside reversal. That's why prices feel detached from logic. They aren't reacting to optimism. They're reacting to constraint. The mistake is waiting for this to go back to normal. Normal depended on conditions that no longer exist. What comes next isn't a reset to the past. It's a narrowing future where access matters more than price, and timing matters more than theory. This story doesn't end with a crash. It ends with separation between paper and physical, between claims and reality, between who adapts early and who is forced to adapt later. And that separation is still forming. If you want to stay ahead of what comes next, follow, subscribe, and stay with this analysis.